I'm glad to welcome you to the Manifested E-Learning platform once again. We continue with the subject finance for decision making. The topic is budgeting and budgetary control. We are in our today's lesson going to consider the last subtopic, which is cost, volume, profit analysis, which is a crucial tool in management accounting that is used to study the relationship between costs, sales volume, and profit. Three elements: costs, sales volume, and profit. The CVP analysis studies the relationship between costs, sales volume, and profit. And this analysis helps managers make informed decisions by assessing how changes in one variable impact the others. How changes in the sales volume will impact the profit. How changes in profit will impact the cost. How changes in cost will impact the volume, and so on. So in this lesson, we study the key components of CVP analysis. We will study the assumptions of CVP analysis and the CVP calculations, three things. So we begin with the components. What are the components of CVP analysis? Components. Now, the first component of CVP analysis, the first component is selling price. Selling price. If you're in business of buying and selling, your products must bear a selling price. And here we are referring to the selling price per unit at which a product or service is sold. That is the selling price. So the first component of the CVP analysis is selling price. Then the second one is sales volume. Sales volume refers to the number of units sold. If you are doing a business, if you are running a company, if you are in business of buying and selling goods or manufacturing and selling goods, then within a specified period of time of, say, the accounting period, you may sell given number of units. So that's what we are referring to as sales volume, the quantity of units that are sold within a specific period of time. Then the third element is what we call variable costs. Variable costs are costs that change in direct proportion to changes in sales volume. There are certain costs that will change when you change the sales volume. Examples of such costs include direct material, direct labor, direct expenses. When you are selling or manufacturing or producing goods or services, there are costs that will change as you increase the volume. They may also change as you decrease the volume. We are referring to them as variable costs. They vary as the sales quantities change. Where the quantities increase, these costs increase. Where the quantities reduce, these costs reduce. A good example is just the material, say raw materials. If you are producing, say, loaves of bread, you require, say, 10,000 shillings as a cost of producing a product. So if you reduce the number of products, then that cost of raw materials is most likely to reduce, and vice versa. So the third element of CVP analysis is variable cost. Then we have what we call fixed costs. These are costs that remain constant regardless of changes in the sales volume. Like if you have premises, you pay rent per month of 100,000 shillings. That rent will be paid whether you are selling more units or selling few units. So there are costs that don't change with the change in the sales volume. Another example is salaries. If you have salaries of say 500,000 per month, you have staff that you are paying 500,000 per month and it is fixed at that. It does not matter whether the sales are increasing or reducing. That amount has to be paid whether the company is selling or not. So fixed costs are costs that do not change with the change in the level of production. Then the last component is profit. Profit. This is the total revenue minus total costs. And total costs here include the fixed costs and the variable costs. So total profit will be equal to, this is equal to total revenue minus total cost. That you get your profit. And we call it operating income. It may also be referred to as operating income. So these are the main components. These are the key components of CVP analysis. Selling price, sales volume, variable costs, fixed costs, profit. Now let's move to the second part of this lesson, which is the assumptions. What are the assumptions of CVP analysis? What are the assumptions of CVP analysis? Now, CVP analysis is based on several simplifying assumptions. And the first assumption is that the costs are linear. Costs are linear. That's assumption number one. Costs are linear. What does that mean? That means that costs behave in a linear fashion throughout the relevant range of activity. Costs are linear. That's assumption number one. Assumption number two is that the selling price is constant. It is assumed that selling price is constant. Selling price is constant throughout the period of analysis. Selling price is assumed does not change. The selling price per unit does not change during that period of analysis. That's the second assumption. Third assumption, all production is sold. All products are sold. All products within that period are sold. When carrying out this analysis, we make the assumption that all the products that are produced in a year or in that period are sold. That means that inventory levels do not change, meaning that production equals sales. All that is produced is sold. That is the assumption. All products are sold. You understand? Yes. Inventory levels do not change, meaning that whatever is produced, all the units that are produced are sold. 4. Sales mix is constant. This is the assumption that sales mix is constant. That is for multi-product companies. If a company sells multiple products, the relative proportion of each product sold remains the same. Then lastly, efficiency is constant. This is the assumption that efficiency constant. For CVP to be valid, then it has to be assumed that efficiency is constant, meaning that productivity and efficiency remain unchanged. Efficiency does not change. So these are 5 key assumptions of the CVP analysis or the CPV analysis. Cost, volume, profit analysis. Cost, volume, profit analysis. Now let's move to the CVP calculations. The third part of this lesson is analysis calculations. Now, candidates, the CVP model uses several key metrics to analyze profit. And the first one is contribution margin. Contribution margin. Number one is what we call contribution margin. Contribution margin is the revenue remaining after deducting variable costs. Revenue remaining. That means that contribution margin is equal to selling price minus variable costs. So contribution is equal to selling price per unit minus variable cost per unit. It represents the amount each unit sale contributes towards covering fixed costs and generating profit. And from this contribution margin, we get what we call contribution margin ratio, okay, which we will give the formula in a short while. But the fundamental profit equation in CVP analysis equal to selling price per unit times the volume, the number of units sold. This will give us the revenue. From this revenue, we deduct the variable costs, and the variable cost will be equal to the variable cost per unit times the number of units produced. Then we deduct the fixed cost. So this is the fundamental function of the profit equation or profit. To get the profit, we have to multiply the selling price per unit times the number of units produced, which are represented by V, volume, minus the variable cost per unit times the same number of units. Then we deduct the total fixed cost. That will give us the profit equation. Then number 3, we have what we call the break-even point. Break-even point, BEP. Now, the break-even point is the level of sales volume at which total revenue exactly equals total cost. At break-even point, total revenue equals total cost. And at this point, profit is 0. Because if your total revenue is, say, 100,000 and your total cost is 100,000, then your profit will be equal to the total revenue minus total cost, which is equal to 0. So at break-even point, the profit is equal to 0. 0 profit. To get 0 profit, then the total revenue will equal the total cost. And this break-even point can be determined either in shillings or in units. Break-even point in units will be equal to total fixed cost minus contribution margin. This is the formula for determining the break-even point in units. That means the number of units that may be produced, the profit will equal 0. Break-even point number 2 may also be determined in shillings. Break-even point in shillings will be equal to the total fixed cost over contribution margin ratio. Break-even point in shillings will be equal to the total fixed cost over contribution margin ratio, where contribution margin ratio is equal to the selling price per unit minus fixed cost per unit divided by the selling price per unit. This will give us a contribution margin ratio. It has to be 0 point something because be more than the numerator. It has to be 0 point something. It's a ratio. So this is how to determine the contribution margin. The break-even point in shillings equal to the total fixed cost divided by the contribution margin ratio, which is equal to the selling price minus fixed cost over selling price, because we saw here that contribution is equal to selling price. This is contribution. It's equal to the selling price per unit minus fixed cost per unit, which is equal to here selling price per unit. So to have it as a ratio, you divide by the selling price per unit. So that is number 3, break-even point. Then we may have number 4, what is target profit analysis. Target profit analysis. Now this calculation determines the sales volume required to achieve a specific level of target profit. If you have a target profit of say 1 million, the question is, how many number of units do you need to produce to earn the target profit of 1 million? That can be determined in advance. And managers use such analysis to predict or to analyze the level of probability that they desire. And that can also be calculated either in units or in, so target profit or target sales units, the number 1, target units will be equal to the total fixed cost plus the target profit divided by contribution margin. This will be contribution margin per unit. To get the target sales units, we take the total fixed cost, we add the target profit, then we divide by the contribution margin per unit. Target profit sales can also be determined in shillings. Number 2, target sales in shillings will be equal to the total fixed cost plus the target profit we divide by the contribution margin ratio. Divide by the contribution margin ratio. So target sales in shillings is equal to the total fixed cost plus the target profit we divide the contribution margin ratio. So these are the formulas we may use in CVP analysis. You have the contribution margin, which is equal to selling price minus fixed cost. You have the profit equation, which is equal to the selling price per unit times the number of units minus fixed cost per unit times the number of units minus fixed cost. Then number 3, we have the break-even point. At break-even point, we've said profit is 0, which is equal to total revenue minus the total cost. It is at break-even point that the total revenue will equal the total cost. Then we can determine this break-even point either in shillings or in units. To get the break-even point in units, we take the total fixed cost divided by the contribution per unit. Then break-even point in shillings will be equal to the total fixed cost divided by the contribution margin ratio, where contribution margin ratio is equal to the selling price per unit minus fixed cost per unit divided by selling price per unit. Then we have the target profit analysis, which we can determine the target sales unit or the target sales. Yes. So these are the formulas that we may use in the cost volume profit analysis. Now let's, in closing this lesson, discuss number 4, uses of CVP or importance or uses of CVP analysis. Managers use CVP analysis for various decision-making purposes. One such purpose is pricing decisions. CVP analysis may be used in pricing decisions, making decisions regarding prices. Making decisions regarding prices. Pricing decisions. Okay. Determining the minimum price required to cover all the costs. CVP analysis can be used by managers to determine that price that can be set which covers all the costs and also which promises profit, because selling price must include an element of profit. Of course, we know that selling price of a product or a good is equal to the cost. If you want to get profit, then the selling price must be more than the cost of the product that you are selling. So CVP may be used in pricing decisions. It can also be used in product planning. Product planning. We use CVP analysis in planning products, product planning, deciding whether to introduce a new product or to drop an existing one. We may rely on CVP analysis. 3, we can use CVP analysis in cost structure management. That means evaluating the trade-off between fixed costs and variable costs. Okay? And we can substitute fixed costs with automation and variable costs with labor and so on. Sales mix. Sales mix decisions. Sales mix decisions. That means optimizing the mix of products sold to maximize the overall contribution margin ratio. What mix? Do we sell product A and B and C? Do we sell product A, we omit B and sell C? Do we sell product A, E, F? So that mix, the sales mix can be made possible by relying on CVP analysis, because then the company can be able to determine which products generates high contribution. Sales mix decisions. Another use is budgeting. CVP analysis can be used in budgeting. That means selling or setting targets and projecting financial results. We can use CVP analysis to set certain sales targets and to project financial results. Then lastly, we have what we call margin of safety. Very important use of CVP. Margin of safety means assessing the risk of determining how much sales can drop before the company reaches the break-even point. So these are 5+1 uses of CVP analysis. And that will mark the end of our today's lesson. In our next session, we are going to get into the calculations. We are going to answer past paper questions that have been tested to see how we can apply these formulas. So please, when you come into our next session, make sure you have a calculator ready to do the calculations. Go through the videos, memorize the formula. When we meet in our next session, we are going to work out past paper questions from the KASNEB. Bye-bye.